Now, on to today's market movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Burio, and we are just days away from the most compelling early part of the earnings season, and that's the bank. Now, we're also filming this on a day where the S&Ps are gapping lower, down approximately 2% right now. We're looking at using S&P E-mini options to either hedge risk or create additional exposure. Joining me is Chief Market Strategist for Path Trading Partners, Bob Ichino.
Nice to see you.
Okay, last time, the first part of earnings season, I always break it up into the tech part, which is later on, and the bank part, which is the second most important part, right front loaded.
Agreed.
We have Citibank, JP Morgan, Wells Fargo. They reported on the same day last quarter. They all posted decent earnings, got pounded, only to recover the next day. What happens this time?
I think a similar situation. I don't know that they recover this time. The issue I have is the repricing, as we've known for years, in terms of rates rising, should be good for the banks. But the reasons that rate rising make the banks go up is not necessarily the case this time. Loan origination is down for the money center banks. Credit card defaults are up. I think they get hit.
Okay, so the rates thing you glossed over. Now, it's taught for 20 years that when rates go higher and the curve steepens, banks do well. But also, Dodd-Frank's involved in this now too. Banks are a totally different animal than they were 10 years ago, right?
Yeah, it's similar to the auto sector where cars are lasting longer. The sort of dynamics are different. The
models changed.
Yeah, sort of dynamics are a little bit different than we've learned.
Okay.
They still get money out of loan origination, but the money center banks, much more diversified.
Interesting. Now, before we dive into our trade discussions, I'd like to point out with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendation or advice. Prices and movements will vary. Like I said, this is a wild day in the markets when we're filming this right now. The last price we saw was $28.45 in the S&Ps.
So I'm still bullish overall, although I think the beginning of the earnings season is going to be a little bit weak. So normally I wouldn't buy with an elevated VIX, and as you mentioned, it's going higher as we speak. But I'm going to do a call spread here because I want to be long going into earnings and I want to hang on to it. So week 3 call spread, the 28.70, 28.90 call spread, I should be able to do it for about a $400 price tag. Hopefully I make $600 on it.
Okay, no, and I like that. And I'm a bull, and I've been a bull for a long time too. But I am looking at it the other way now. It seems like we've had some weakness over the last few days, and for some reason this weakness seems like it's going to last a little bit too. I am core long a lot of things, and this is a hedge as well, so there's two different ways for me to look at it. One, I think I can make money on this put spread I'm about to give, but two, if I don't, it's a hedge to some of the things I have that I don't want to sell for tax purposes. Now I'm looking at buying the week 3, 28.50, 28.25 put spread for 10 ticks. Now this is 5 ticks in the money already, and like I said, this thing is whipping around completely. Expires October 19th. Decent underlying 28.45, risks 500 to make 650. Thoughts?
So I'm going to look like a knucklehead saying this, but I actually like your example better in terms of the probability of that actually working. I am bullish long term, but I think we're going to continue to get hit. VIX is rising, rates are not slowing down, so I think there's more downside. Yeah. I just want to participate if I'm wrong.
I gotcha. No, and I like it too because, like I said, it's 5 ticks in the market already. And to me that matters because it gives you a little bit of a cushion against losses.
Absolutely.
All in all, how long does this weakness last? Does it last through the first part of earnings season? Does it last till rates stabilize? What happens?
Middle of earnings season, rates should stabilize. That's kind of been my core sort of position. I don't think rates are going to get above 325 on the 10-year and stay there. They've gotten above there, obviously. I think they're going to dial back just like we did at 3%.
I hope you're right, because I don't think it's the rate, it's the pace that we got there, and we got there too quickly this time. Thanks for joining us on Market Movers. I'm Jim Burio, where we're hoping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.